The purpose of this book is, like, before we drive it into the numbers, let's clear about why we are here and why this we are, like, as a project manager. Like, I don't know how many as a project manager, but I can suppose to be everyone is like project management part of a project management, or maybe they are supposed to be become a part of the project management. So here with the fluence, like financial fluencies, to see the beyond the schedules and scope into the strategic heartbeats of your organizations. Like, by this book they can help you for the three things, that is diagnose the organizational health. It's just not by the whether the project is like completed on time or not. It's not about, it's about how the like cash flow, how the profitability, what about the balance sheet it is. And the second thing is, make the better decision. Oh yes, if you are in the project management, then you can take the better decisions. But maybe for the technical basis, you can take it. What about the financial? Because if you will not get any funded, or if you are not on finance, then how you will get the decide that your project is success or not. So for this, what's the ROI? How does affect the working capital? It's the profit real or just according to the estimate? We will learn here. And third is delivery of the real business value, where we can learn about how you like how your project comes with the strategic finance, uh, feel free cash, return on capital, and stakeholder value. And like, it's also directly supports the PMI triangle, especially for the business acumen dimensions. This session and this book. So this book, that's the reason we are taking this book, because we already covered two, like, way of working, and the technical part we already covered in the previous session. You can go and like see the YouTube channel over there of our book club, and you can get the things. That's a business acumen dimension. So we are covering this book. Now you get it, right? Uh, Lizzie, next. Now I have a one question. How many fee? How for how many persons finance is just a number, like maths, like calculating maths, or not a art? May I know how many persons is think like that? Anyone? Anyone who is thinking that finance is just about the numbers? Like Lizzie is saying, I don't think it is an art. Okay, I'll make you to clear how it is an art. Okay, anyone else who is thinking the same? Well, let me clear you one thing. Finance is just an art, not maths. Finance is just not about plus minus, multiplications and divides. No, it's just beyond us. Uh, okay, it should be science, not art. Okay, I agree. Science is also a type of art. Well, here in this book, the author concept, while the things is, for finance is just not a number, it also the interpretations and the judgment. It's a great project leader, like don't just accept data. They are, you need to they ask the question, like what assumption were made when you make the things, what happened if the condition change. And just as we challenge the financial assumptions, like financial intelligence is means to understanding the story behind these spreadsheets. For example, whenever you create like whenever in, let's take a normal example of your journal life. Like for example, if someone is uh, handling their management one, and basically the women are always taking this management part. So what they make a sheet and they are analyzing. Have you ever think how she make the things, or he makes the things, the spreadsheets? Like, I have that much money and I will make the money like that, and things will be organized. This things as art. It's just not about the like the things plus minus profit and loss. No, it's just about how you manage the things in small amount. This is the why the finance is an art. Because while deciding anything for your project, for your anything where you are like investing, where money is there, So it's come to the finance. So when you have a large amount of money, you are thinking like that. When you have a less amount of the thinking, like have less amount of the money, you are thinking like that. So it's totally about the ability to see your story behind these spreadsheets. That's the reason here the author is saying finance is an art, not just a myth. Okay, can we go? As I earlier told you, like finance is art. So here the related bit. The numbers are interpretations. Interpretations, not the fact. Because no number is fact. For example, if we are taking about the populations, number of population, it's assumptions. It's never be a fact. The number of population which is given is it's a fact. No, that's an assumption. So similarly, the financial statement is look like a factual, but they are built to on estimate timing choices. For example, choosing a depreciation period of 3 years versus 6, you can see there is a drastical changes in the profit, and the revenue recognitions can make the result look better in one quarter, but weaker in later. As PMI, what you ask, you first thing you come in your mind, what's the behind this reason? It's about the thinking critical before or making a business decisions. No, it's not about it. Whatever numbers you have, it's just our interpretations. It's lump sum about to, it's not a perfect. So on the basis of that data, you always recognize the things, how the things will go and how the things will be, like will be go in the future. These are things. So that's the thing. Numbers are always interpretations, not fact. So don't take the numbers as a factual basis while you are making any balance sheet or something. So take it as it always assumptions. Please. Okay. Now, what is the difference between the accounting and the finance? Can anyone explain me what is the difference? Like accounting and finance? Well, accounting means records what happened in the backward looking. Finance is looking ahead, like planning how to grow or uses resources wisely. Like when we are talking about the project manager, we just connecting both by turning data into like action. Like as we are like you are the project manager, you will not see the accounting. You will go with the finance part, but where you need to convert your data into the decisions and delivery strategically, like as per the record, whatever it is, and the value you need to. But there is some questions is always there for the project management. Is be there like have we should I analyze the past like accounting accounts? Can I go with the what should we do in the finance? Like these are the questions should be come there in the project manager. This is very very important for us, because if you know what's the pro and cons with your finance and the your finance part of the projects, then you always prepare for your worst to worst part and the greatest to greatest part. Because sometimes you heard like in the last moment, oh, the finance is not there, that's why the project is cancelled or delayed by the customer or by the client. I know many of the many of you heard from your team, from yourself, or for the clients. There's a reason. The reason is behind is it. So for the if you want to become a project management, you always be like there. Please next. Okay. Profit is an estimate, cash is reality. Like profit is just not estimate, cash is reality. Here is a some like this is a famous quote actually. Profit is an opinion, cash is fact. Highlight that you can't spend like you can't spend a profit if you don't have cash. Like project is often delayed because of the cash is overlooked, yeah overbacked. Even the budget is look fine. Well, when if there is a smart like PM, then model should be become like money comes in and goes and out. Always remember the on the budget doesn't guarantee the liquidity. This is the key of the project management. So whenever you are making the finance, making a budget of your project, the keep on in your mind, profit is just estimate. Because when you, like for example, you spend $2 in your project, but you spend it, but how about this is your cash in reality, $2. How about your profit? So on the basis of your cash reality, you can imagine your profit, but it is not fact. Please. Now, here is a four financial statements. That's one is income statements, another balance sheets, cash flow statements, and statement retaining the earning. We all know these about it. Why these four statements is required, and we already faces like one is for the revenue, another is the assets and liabilities, cash for the liquidity, and the statement for earning is cumulative value. Now, next is income statements. Income statement means the value which you please. Income statement means value engine, like how you give show how inputs like revenue. For example, how effectively company converts the resources into the profit. That's income statements. Similarly, we are like doing in your project, but always ask your PM the project delivery directly the your revenue. It's reduce your COGS or operating expensive. How impacted your like operating margin? You always keep these questions in your mind before doing anything. Yeah, before go with your projects. You always want the revenue, whatever the projects you are taking, revenue generated. Like it should be a revenue generated. So this is the thing. Income statements, the mentioned by the author over there. That's a value engine. Income statement is a value engine. Sorry. Just Lizzie, can you continue from here? I'm shorting pin.
You need a minute? Okay. Do you want me to start from balance sheet? Yeah.
Yeah,
So the
please help.
I love the way you're presenting this because the book summarizes it beautifully, but you do a nice job here of giving people the key points. And that is, what's the balance sheet meant to do? As you talked about earlier, there's finance and accounting. And balance sheet is essentially the accounting of what? The assets, the amount outstanding, the amount due, and then more complicated things like shareholder value and goodwill, as it's called, so that you really understand what kind of value the company is creating through its assets minus its liabilities and equities. That essentially tells you you could say, current value of the company in a point in time. And she says here, the PM impact for us is that our team will understand where stakeholder trust is balanced with the assets. In other words, you want to grow your assets, limit your liabilities, and increase your shareholder equity. That's the goal of companies. And a strong balance sheet is one that we can help manufacture if we know that our project's goal is to increase either the total revenue and total inventories, or decrease things like the cost to run things, the liabilities and debts required to run things. So understanding how your project relates is very important. Next, we talk about cash flow. And I love the statement earlier made about how cash is reality, because even if you have the best revenue story, and we know all of us, I think, stories of things like Enron, where they showed great financial projections and they were able to cook the books in a way that showed that they were doing fantastically on revenue generation. But if the cash isn't coming in because you're cooking the books and the data is not real, or the cash isn't coming in because you're not collecting from customers who owe you money, you can't run a business. We all know that. I mean, imagine if you didn't get your paycheck and you still had to pay your bills. That would create a cash flow problem. And in fact, this issue about profitability not equal to cash is really down to the problem we saw with the housing market. Liquidity is what is the problem of over leveraging. So you've got too many debts outstanding and not enough cash coming in to service those debts. Then you end up with a liquidity problem, which is when you, for instance, have a lot of debt on your house and then the value of the house goes down, they call that debt and you can't pay it. So that's the kind of thing companies have. And a lot of companies that have done well have actually had investments in things like housing and buildings and have had a great revenue, but have had this huge amount of debt on their books. So understanding cash flow is really important. And actually understanding this common project management blind spot, assuming an approved budget is cash available for you to spend on your project. It can be. I've run projects that are 7-year long projects. And so we had an overall budget, an annual budget, but then we always had to have that cash released to us so we could spend it. And that has to do with quarterly reviews internal to the business, where the business says, we had a terrible quarter. So even though we gave you $1 million budget, you can't access fully that budget because we've had a liquidity problem elsewhere in our business. So we have to kind of rein back what we're spending. Maybe people could answer in the comments or in the what do you call it, reactions, if you've ever had that happen where you thought you had a budget, but when you went to ask for that money to be released to you, it wasn't available. Anybody had that problem as a project manager? I certainly have had that. But like I told you, I've run really long projects that have been multi-year. And then the issue about timing, inflow and outflow, that also relates to projects because when we're doing a project, we're often creating an outflow of cash. In other words, we're paying bills to buy stock or buy assets or buy services so we can implement a new technology or business process. There's no inflow yet for that because the value of it hasn't started. They haven't gone live with that project. So delaying the time we take to go live or increasing the amount of expenditures without planned income from that work we're doing on projects can really affect the business, and you can lose stakeholder value or stakeholder agreement with your project if you don't show a good matching between potential money earned and the amount of money you're spending on a project. So cash flow is oxygen, as Richa says, and as the book reports. I think that's an excellent point. I'm going to continue going on because she needs a minute, so we'll just soldier on. GAAP and IFRS. So GAAP is generally accepted accounting principles, and IFRS, I don't actually know from my top of my head, but it's another acronym that is the international framework of accounting rules. And if you're a corporation in America, you must abide by GAAP. And I would say that most of the countries that we're involved in might also be using IFRS. I see our friend has come back and she knows more than I do about this topic, so I'm going to let her. Richa, are you ready to take over? You're on mute, darling.
If you want, you can continue for this slide.
Okay. All right. I'll finish this one off. So PMBOK and a lot of other things are based on a lot of American rules. So you'll see that the way that we do EVA, if you remember our process of how to evaluate your current value of your project and how close you are to reaching full value, those kind of things tend to follow the GAAP concept of how you manage depreciation, how you manage cash flow, and how cash flow relates to income statements. So understanding what kind of accounting rules you're using and which accounting rules matter for your business, because even American companies use GAAP for financial reporting, like to the SEC, but they actually use other kinds of management reporting internally. And you need to know which of those things are the levers that your internal stakeholders, your customer or your business leaders are looking at to know what kind of ROI or what return on investment are they calculating for your project and for the company as a whole. So this is why we consider financial to be a key to business acumen. It's about knowing when to follow the rules and when to question them, and also when to find out what the rules are. So that might be the first step here as well. And certainly in PMBOK plus Agile, we still have to follow the financial frameworks of the business, whether they're international or domestic, wherever they are. Ratios, back to you.
Thank you very much, Liz. Like from here, there is a some before how now question is arises, how we decided for your financial steps for your projects, like how we decided, like there is a some ratios that's provided by the author. We are generally using in my project because now we are following, mostly organizations are following the PMI agile, and especially our people now organizations following fully the PMI. So as per there is a some ratio like ROI, ROE, current ratio, office like profit margin, debit to equity, which is this used to be justify your funding, your interrupt the health of your project, and it's just not for the compute. It's just for you to help you understand where is your project right now and where will be. These are the ratio which help you to understand. Like for example, ratio is just like for you KPI. KPI is like key performance in your key performances, uh, where they turn your raw data into the insights, and ROI tell you if an investment is worthwhile or not, and your current ratio will measure your liquidity. And when we are talking about the debt to equity, it's your financial risk. It shows your financial. These indicators just justify that project funding and your stop warming, like where you need to be, like where they will we have some alerts like green, red, orange. If you are in green, it's good. If you are in orange, it's good, but you need to be balanced because you need to come to be back into the green. That's the ring. And in red, red is danger zone because everywhere, whenever you see the red, it's just a danger zone. Here also, red is mentioned a danger zone because your project is in ROI, and maybe not sure. It's how to be zero and negative. So you if you whenever you went to the ROI, you just move to your orange. Then from orange, you need to be go by green. So that's my reason in the before two slides, we are told you that the things is going on the base of the past, then present, then future. That's the reason financial statements is very important. Now, this is the DuPont formula. I think how many I want to know how many think about DuPont formula. Have you ever heard this formula? Like DuPont,
We
DuPont
have a
formula.
comment coming in from
Yeah.
Carolina, but not yet. And I said, I feel like I have heard it, but I would say generally I don't know what it is. So it's great you're here to discuss it.
Okay, let's discuss about it. Two-point formula is just break your ROE, the return, your return or equity, into the three things, that is profit margin, asset turnover, and your financial leverages. It shows how efficiency, your profit, your funding, mix and interactive. The three things is missing over here, and we can apply the similarly like thinking. Like for example, uh, for projects, the delivery speeds, cost control, if you are talking about, and the third is risk balance, like affected to the outcomes. These That's why it's called a system thinking, because it's, as you can see, do point means it's related with some financial thing. System thinking is just something about we are thinking like I already when we are delivering any projects, three things we are in: cost, delivery, and their outcomes. The three things will come. That's the thinking. That's the reason DuPont formula is just compare with the system thinking in this book. So whenever you are following system thinking, that means you are following the DuPont formula. So it's lump sum almost same things. So that's whenever you go for the projects. So that's the reason the in this book was in somewhere in line, author is mentioned this. We are following the same things, but in this book we are comparing all the things with the financial concept. So you get to know that finance is very important for every project. That's why we are here for this session. And yes, these three things is impact your whole project. Now let's go the another. That's a cash conversion cycle. Cash conversion cycle is triple C. It's basically measure how fast the company turns into the cash, and how shorter the shorter means the cycle, better the liquidity. PM can apply the same logic to reduce your like hand of delays, speeds the approval, like negotiate your milestone, the payments, operational agilities improves both for the project performer and the cash flow efficiency. So that's the reason the here in this book the author is emphasis on the cash flow, cash conversion cycles. That's the reason, because I already told you cash is which is very important. Cash means you are investing the thing. Cash is just not that liquidity that in your hand. That paper, I'm not talking about that paper notes or coins. I'm talking about the real cash. For the real cash, you need to be like cash, payables, inventories. Then debts is need to be receivable. This is the cash flow, cash conversion. Cash is just not about you invest and it's not come back. It's not a cash conversion.
Can we ask a related question to this? Because Carolina says, I never see cash flow in my portfolio. I manage product portfolio, but I'm curious about it. Someone have any experience in cash flow product level or in only corporate level? And maybe you have an answer for this. I sort of have an answer for this because I just did an MBA program, and as I mentioned, it had finance in there. So from my perspective, and let me check this with you, Richa, the issue about why you don't have a cash portfolio as part of your project is because your project is showing up as a payable in this model you've got here. So they're not looking for receivables or inventory or cash flow yet conversion, because you're in the debt creation moment when you're building a project. It's when you release that project to the business that cash should start coming in from some lever of change that your project's creating. Would you agree with that? Would you add to that somehow differently?
No, actually, I totally agree with you. But yes, rarely people like heard about the product level. But yes, cash flow is also the product level. I already told you in the previous slides. Something is financial, but we are thinking the same. In my previous slide, I told you that system thinking. System thinking is similarly like the don't formula. Don't formula is for the financial, when where you calculate by the formula. But system thinking is just we are following that. At the product level, the cash flow is also there, but in the it not the term of the money. It terms of another thing. For example, if you are taking the product, let's talk about that. How can I take the example? Okay, let's talk about if any software. Okay, if you're making any software, you are not taking the financial part, but you are taking the technology part. But you are taking the technology. But you need to check that whatever input you are giving, whatever software you are making it, like it is your input. And what's about your output? Output is your the usable, the user who is uses your software. This is your output. So somehow it is like cash conversion flow. That's why I clearly mentioned my slide. That's called a operational agility, not the agility. It's the agility. Agility and the cash conversion flow is equal. Cash conversion flow is a financial side, and operational agility is just something like handling the projects. It's a front end part, and cash conversion is a back end part, because every project have two three parts there. One is front end. Front end is where you are making everything and you are delivering the thing. Back end is always finance. If finance support is there, finance pillar is there, then the front end will become. If finance pillar is not there, then the front end will not become. That's the reason. Hope your doubt is clear.
Yeah, I hope that answers your question, Carolina. Maybe we go on to the forecasting. Thank you for that answer, Richa. Oh, yeah, she says thank you also. Thank you.
Now, forecasting strategic identification. Like here, the great leader just not track. They are predict the forecasting, help you the plan for base, update, downside the scenarios. Like these are the things. In project, this could be the mean of the anticipated risk, schedule the leakage, maybe the funding delay, anything. So these are easy. So building the financial foresighting, it's your business acumen. It shows how like it's You are just not reporting your progress. It's you are preparing for the future outcomes also. For example, in the future the resources will become expensive. Then how you manage the things? So this is the things. So that's the reason the things is going on. Okay, now we are thinking about the owner. Well, owner, whenever we are thinking about the owner, na, so owner is just something become like for us. You have your own property or you are become something. It just comes. It's not like you feeling like that. For me, it's become like that feeling. Like when you say to someone that you are the owner of that thing, you are the like project owner, you are a product owner, yeah, whatever, software owner, a developer owner, whatever it is. So here also the author is emphasizes while you're doing anything, just take the decision. You are the owner. You are doing this is not about you are doing because it's your responsibility and the person is higher for me. No, whenever you think about it, it is the money and everything is going from my sides, then your decision will be something different. Whenever you think you are doing for someone else, then your thinking will be something different. So whenever you take the decisions, like owner is saying, owner is always asked like how, would I invest my own money in this or not. It's just a question you need to become. Owner always focus on the long term value. It's just not the focus on the short term value, because always short term is short term, like short term option will be give you the only the short term things, nothing else. So your mindset is always turned to the true business partner rather than to the like become a small part of things like ratio partner, the things. So that's the reason we always think about the owner. When you start thinking about the owner, your project will change. You will think about more about more beyond the thinking which you never think about it. There's a reason we always think about the owner.
I love this slide, Richa, because I really feel strongly about this as project managers. As you say, we tend to think about scope and quality and cost. But when you can shift to thinking like an owner, your business will see you as a more executive peer to them because you're able to speak the language and think like these senior stakeholders think. So I love this slide. I think this was a really good part of the book and that you brought out here. Thank you for that.
Yeah. And let's go with another slide. What's next? I also remember, I don't remember now. While I'm making that, that time I remember, I don't know what is the next slide. Let's go. Now it's human side of the finance. Let's think about it. Human, what's come in your mind? What human is thinking? Let's come out. Like I already told you, finance is just not a number. It's influenced by the pupil. Like optimistic basics, pressure to meet the target, like short-term rewards can always a short-term like distort your results. As a PMI, you need to balance your emotions, intelligence with analysis. Like for the if we are talking about the human side, for the human awareness, help us to understand why financial data look the way that does and lead to more honest, grounded decisions. Because as a project managers, we always have some situations there where we need to take either like maintain our EI, emotional intelligence, to take the like hard decision or harsh decision. So here in this book, author is also talk about that emotion things. So never take any decisions emotionally or by the influence of any. Just think about the data. What is the data and what is the fact and interpretation is saying. Now budget. But everyone is know the budget. I know this. I know very well because everyone is getting the money, salary, earning like various way. They have their own budget. Every month they have every week like we need to like for example me, I need to visit Europe next within the next 2 3 months. So I'm start making my budget for my trip now. So I am just saving some money and I'm like so this is my the budget. Budget is just a strategy in numbers where you can decide. For example, if we are talking about the PM, as a PM, you must be sure about your projects aligned with your financial goals, It's just not the operational ones. And think your budget as a tool, like strategic communications. It's just not a cost tracking. So while whenever you are making the budgets, please use the tools. Tools will always help you out to how is budget is going on, how much budget is spending, it's in your budget, outward the budget, or more than the budget, overloaded. It's totally help you to know. And the as a PM, you need to always KPI, ROI, ROE. I already told you, you need to be in your mind always.
Can I add a question here? It relates to what you just mentioned about ROE and ROI. So we have a question that says, who should access return on equity numbers and also cash flow in a project? In my company, data is very restricted, confidential, and so they don't always share the information. So I think here we need to recognize that there's public companies and also private companies, and private companies don't need to release this information. Any thoughts?
Well, let me clear you one thing. It's totally depend upon which project you are handling it. For example, I told you every project have their financial pillar and another is a technical pillar. If you are in the technical pillar, then you don't have access to go with the like your backend pillar, because backend pillar is something different. But here is a who should, yes, project manager can access, product owner can access that ROE and cash flow in your project into your project. But if you ask anyone what is the ROE, they never tell you. But yes, you can ask that investment. That's what's the budget of the project. From that, you can analyze as your level. Because, like, let me tell you, I am the your client. Like, I have a $300 project, but the organizations never said to their employees that's a $300 project we received. No, they always said we received only $200. $100 will be always there. So that's the reason. They always tell you only the shorter reason. Always short. The reason behind is maybe the budget will be go overflow, or they are making initially profit margin. There's so many reasons in, because it's totally depend upon the organization to organization or company to company.
Maybe I could add two other facts to what you've already said. One is if your company is public, they have to have some kind of annual report. I have a whole video on how to analyze an annual report, and you can really get an understanding of what kind of return on equity in general, percentage-wise, your company is looking for. If you know your ROI, you can guesstimate your ROE from that. The other thing is your product owner or your client may know that, and they may not be able to tell you because finance is strategic, so they may not want to talk about all of their strategy, but they might be able to give you indications or actually share the number if you're an internal person to the organization. If you're an external like I was for years, they shouldn't share that with you. Actually, that's confidential information, as you said. So it can be derived, it can be computed, or it can just be given as a component of your financial numbers based on annual reports.
That's true. Because let me clear you one thing. I told you there's a one pillar, front end and back end. Let me clear you one thing. I don't know whether people know about it or no, but yes, it's giving the information in the back end. In the finance stage, there is also a one more stage is there, inner stage, where these are things is going on also. Like say cash flow, ROE, they are also following the same way, but they have their own strategies, their own formula. So every pillar have their own. Even when as a project manager, you never told your team member that's a budget of the projects. You always kept some money from there for the for if some crisis in the project, you can flow the fund at that moment. Like resources are high. That's the reason.
Thank you for that. Really good.
Previously, I'm telling you that there is some pillars. See, financial intelligence cycles. Like I already told you that we need to observe, then interpret, then decide, then measure. Then again, you need to observe, interpret, decide. These this is a cycle which is going on not only financially, it's going on everywhere at the product level, project level, everywhere, in every professions in your life, it is going on. Because you can, like, when you read it, it's read a number, question them, like make a smarter choice for this when you are following this, because this cycle not build your like stronger financial understanding, but also increase your leadership, and it also like reflect your financial and strategic sharpness over the time. Because when you observe the things, that means you learn something. When you interpret the things, that means you learn something. Or when you decide, that means you observe, you analyze, and you decide, and you implement it, and now you are measuring again. From that measure, you are again observe the things, then you again interpret the things, you are again apply to use. This is the things, learn live. It's there's a one some quote, I don't remember. Learn from your past, apply in your present, make your future bright, something like that. So financial cycle is going on that quotation. Can we go next? Oh, now working capital and resource agility. We already discussed about it, like working capital and all. We will just go the brief. Finance team manage the receivable, payable, and the inventories, and PM handle the same context through context through the capacity, dependencies, and their work in projects. But yes, I ordered once. I told you initially, both require to be balanced. Like too little, too flexible, slow you down. Too much tie up the resources. Smart PM manage the liquidity in the resources. It's just like manage the cash. It's also all about your cash flow. So PM is like PM have to manage their capacity, like vendors, clients, and all, like work progress and all. But when we are talking about the finance manager is need to be like with the cash flow, cash outflow, and how much like capital is tie up. They need to be like maintaining. But yes, both are the same. One is like handling by the money, and another is handling by the resources. But things are same in the meaning.
Can I add one thing to this? I really like this slide because it talks about some things about what project managers need to keep in mind. And I was talking to Enrique earlier, and he works in manufacturing projects in part, and I did have two in the past. And one of the things we saw during COVID is a lot of companies that were running just in time for work in progress. So they would buy materials only when they needed it, or subparts, so they weren't raw materials, but they were parts needed to finish products. A lot of companies have changed to have a larger stock because of supply chain breakdown that we saw during COVID as COVID ended. And so it might be in your project, you need to be aware of your company's strategy change on keeping work in progress, not just the work in progress of your project, but the work in project of your outcome, the work in progress of your outcome, if you're doing something like a manufacturing or inventory related project. So I like that. It just triggered that thought. If you have any other thoughts about things that you've seen on projects, you can go ahead and put them in the chat. Next slide.
Open book culture. Yes, one thing I need to be tell you. Author is emphasis, especially John Case, is emphasis of the open book culture and emphasis. I think Karina has asked us, right, to be confidential and all. Like, this is your answer. This is your answer. Here, author is emphasis. Like, always, organization need to share their financial status, that increase your ownership, that increase your transparencies. That's the reason. But never. And when you share the financial, it increase your accountability, it increase your faster and smarter decision maker. But like to build this, when people understand how their work affected the cash flow or ROI, and they take their ownership, and the transparency culture will be like transform the employees into the contributor, not it just to the executor, as I told you before. But yes, in some organization, they are like giving some in their websites or whatever it is, in their portfolio, you always mention about their organizations, like how things are going on, how much they expended, what's the target. And there is a one sheet the future sheet is there. In organization, there's a different sheets is called. But yes, in every organization, if you want to go a particular project and you want to know, then you need to follow with this sheet. And for this, you need to go with your like statements, financial statements. Then you get to know what the thing is going on. But nobody comes to you and share you the full detail. Now, the thing is integrating the finance and strategy. Uh, Now the question is arises, like finance, we talk about everything. How we strategies? Like finance and strategies should be never operate in the silos. Try to understand this. Every project have a measurable financial outcomes like cost savings, revenue, efficiency. But as a PM, you must define the track these benefits by this life cycle. When you connect your things with the KPI, your financial results, then you can evaluate your things as a project management to the strategic leadership. Well, let me clear you one thing. For finance, if you are have some finance part, then you can increase your leadership parts towards your project. Or if you are supposed to be like you are the only team member in your project and you are not the owner, but yes, if you start taking the leadership, you want to take the leadership, you need to strengthen your finance part, because finance, which is very important of the project, it's not about the input, it's also about the output also from your project. What will be the output come as is showing in the figure? That's a project delivery and the outcomes. That's why this pool is, I make this pool to clear you very well in the slides. Now question arises, how we become a smart PO. To become a smart PO, you just need to be strategic partner, you need to be the financial thing, but from where you will start? You need to start with your basics of the finance. Review your ROI regularly, and you just align with your OKRs, with your cash impacted. And to become a mature PMO, you need to be when to end the projects no longer created the values, like finance influences strengthening your finance, it's position to PMO to strategic advisor, not just a delivery team members, because finance is something everyone is running from there. They are just delivering, they didn't come back. I have a, I read somewhere, before service is giving everyone, after service is the key where you can make your image. So this is the thing for the PMO. Our next slide is related to the today's sessions. That's a PMI, like finance, like intelligence and the business acumen, like why we are here. This slide is summarized about the entire book, where the relevance to the PMI business is PMI, like PM's business acumen pillar, and the finance intelligence means more to understand about the numbers and the story behind the numbers. And PM also, who are the PMs apply these cycles to become a business leaders, not only them become a project manager, and also create your measurable impact, not just managing the timelines, to go beyond that timelines. When you go with the beyond the timelines, then you will achieve the things, like analyze the thing, realize the things, observe the things, analyze the things, then interpret the things, awareness about that take the decisions. Then again you realize, analyze, awareness. This is the cycle which is going on whole the life. If you implemented this cycle, author is saying, damn, he's the both three of the author is very sure about it. You become a business leader, because finance is just like something global. It is, it is applicable globally, not about the particular things. Is applicable for the globally. If you go, if you whenever you go, I don't know how many you are reading the newspapers. If you have the newspaper, it's good, but I request you to all go to the economy page in your newspaper. You get to know the how much this number is value in your life. It's not strategically, it's make you decision, it's make increase your decision power and the leadership also. In my next slide, I just mentioned few like 7 insights, top insights, like I summarize told the things about in the slides, like core lesson from the sessions, like number interpretations are not fact, profit is just not a cash, question assumptions. You need to always ask the question from your numbers. Think like a owner, translate your financial like insights into the decisions, and separate average the PMs to business leaders. These 7 points, which are very important as a PMI professionals to implement in your projects, or to go to the project management part or further, because project manager is not the DN of the professions. Let me clear you beyond that. I have a one. This is a story I added especially for you. In this, there is a like this is a real story. You can go and check. This is a real story. Here, the thing is going on. The cash tight season was going on, and at that moment, someone is asked, "What's the labor cost?" So, and the team member said, as they are better for use this cash, because at that moment shortage of cash was there. So some team member asked, "What's the labor cost in this particular machine?" And like, are there better uses for this cash? So someone is replying that project, and they propose that the propose they are like they thought they hired some laborers, then they will work and like that. But they drop there after listening these questions. They drop their mind and they changed, and they said the proposal was dropped. You don't need NPV, and now need to ask the smart questions about this. A team is proposed during these days, like where cash flow is very short, that buying a new machine that is a 80K dollar, and but a technician is there that fix it for just a 2K dollar. This decision is save the money. When you decided that rather than to go with the labor, they buy a money, like they hire the machines and only. So this is a perfect example, for the financial intelligence. Like they know how the cost is, like they have a shortage of the budget, but they need to complete the things up now in what they able to. But at that moment they decided the 80,000 is just something like a huge investment for them. But that 80,000 is just not for this project only, na. This 80,000 is for another project also, and they always need to give that payment in the cash to the laborers. So that's better. And for the technician, they need to give only 2,000. So they save because they think about the long. They are not thinking about this project only. If they think about this project only, then they will not like accommodate this machine. They will go with that labor and all. This is the real story.
I think it's a great story because project managers are appreciated when they think like entrepreneurs or like business owners, as you said. And this is a story about thinking like the owner, not like the operator. Like the operator of, I just need to spend as much money as I need to spend. So thank you for that. It's a great one. So the book Richa leaves us with these closing questions for your reflection. How does my project impact the business's cash flow? And what financial intelligence skills do I need to become the business leader my organization needs? So take care, everyone. We'll see you soon. And thanks again, Richa. Great job. And thanks to Emma for running the technical, and Martin and the German chapter for sponsoring our event. Have a good one. Bye bye, everybody.